What's up, traders? John Papa here, and today I want to talk to you about adapting to the market. It's an essential element of a successful trading career, and in this video, I want to explore some of the areas where adaptation is required when trading the markets with discretion. Before I talk about how to adapt, first let's discuss why. Why do we need to adapt to the market? Well, the markets are expressing the sum total actions of all of the buyers and sellers who are participating in a given market, many of whom are acting on emotional impulses. Because mass psychology is driving the markets, this leads to an ebb and flow of constantly changing conditions. Therefore, it's imperative that you take into account the potential of a changing market and what that could mean to your trading strategy. For about a year after I found my first consistent trading strategy, I was very focused on creating rules around that strategy, systematizing it in a way that I hoped would lessen the number of errors I made with decisions while in a trade, and also potentially allowing me to automate that strategy in the future. This was working great for many months until the market that I was trading started drifting in a way that was slowly eroding my edge. Things I was doing previously that were giving me large winners were now resulting in me giving back large amounts of unrealized profits. Rather than understanding and accepting what was happening, I went in the opposite direction and I tried adding more rules and structure to my trading. This was when I first started experimenting with automated trading and backtesting strategies with a computer. It was during this period of heavy computerized backtesting that I realized the answer to my problem wasn't imposing more structure on my trading, but rather becoming more flexible in what and how I traded, adapting to what the market was giving me. This led me to being acutely aware of three major areas that I need to constantly monitor in order to be able to fully take advantage of all of the different conditions the market may throw at me. First and foremost are the big picture strategies and setups I trade. The efficacy of different strategies comes and goes with different market conditions. Big picture news or events can lead to certain sectors seeing an increase in volume and volatility. Entire markets can become very calm and non-volatile, or explode with multiple massive runners on a daily basis. This is what happens with the OTC markets in general as they experience hot and cold periods throughout the year, and this happens with listed stocks as different sectors gain the focus of the majority of active traders for one reason or another. Coming into 2020, I had 12 distinct strategies that I employ in my trading, encompassing long and short trades on both the listed and OTC markets. The reason that I spent years focused on learning different strategies rather than growing my accounts was so that I would be able to take full advantage of any conditions the market could throw at me once I started trading full time. I knew I wouldn't have the luxury of sitting on my hands for weeks or months waiting for a specific strategy or two to have its turn in the spotlight. And this has paid off handsomely for me this year. In any given week or month, I'm generally focused on 2 or 3 of my setups, and the mix of which setup I'm trading is entirely determined by what's most effective at the current time. As of this month in August, I've cycled through all of my setups throughout the year. Some strategies working for months, others for weeks, and others for a day when the right trade shows up. Earlier this year, there was a couple-month period where I was focused on shorting listed stocks almost exclusively. Now in the past 2 months, I've mainly been focused on buying OTCs, and I've only shorted 1 or 2 listed stocks. I take what the market gives me, and due to my extensive collection of stats on how my strategies work, I'm able to quickly shift focus when it's clear that the market is changing. In August, we saw what I would normally expect to see most years starting in May or June, and that is classic summer trading. Every year, the markets usually quiet down during the summer months as people are taking vacations and the overall volume and volatility of the market dies down. I believe this is where the phrase sell in May and go away comes from. So you always have to be aware of how well your specific strategy is working in the current market environment, and be ready to just sit on your hands if necessary and wait for the market cycle to come back around to offering you your best plays. The second major area of adaptation that I constantly monitor is adapting my aggressiveness to the current market conditions. And this mainly involves varying position sizes and the amount of money I'm willing to risk per trade, along with how willing I am to put on very speculative trades. In quieter times, such as the summer trading period we're in as I'm filming this, I will really pull back on the speculative trades and try to stick to only trading the best setups. During more volatile times, like we were seeing earlier this year during quarantine, and the kind of market conditions that we usually see in the winter, I'm much more inclined to put on speculative trades or take less perfect setups, as the overall conditions can lead to some lucky big wins when a stock randomly makes a huge move for seemingly little reason. The other way that I modulate my aggressiveness is by varying the amount of money I'm willing to risk on any given trade, which in turn affects my position sizes. I use the Kelly criterion along with my stats for each setup to determine how much to risk on each trade. I generally bet half Kelly, but I may back down to betting as small as 1/5 Kelly when the market's just not offering very opportune trades. Or I may ramp up my size to betting full Kelly when the conditions warrant it and I really want to be aggressive with my position sizing. So it's always good to be aware of how much opportunity the market is currently offering and vary your aggressiveness to take full advantage of your edge in the market. The third main area of adaptation that I'm always aware of is holding times and how patient to be in a trade. For my day trades, ideally I want to enter in the morning or shortly after and hold all day. With my ideal swing trades, I want to hold for 2 nights, selling or covering part of the position on day 2 and holding the rest for day 3. But that's only in ideal conditions. So oftentimes the state of the market is such that I'll exit a day trade into the morning spike or the morning pullback if I entered in pre-market or near the open. And with my swing trades, the market may not be offering a lot of multi-day runners, in which case I'll be more likely to sell my position after just holding overnight, or even selling into the close, making it a day trade rather than a swing trade, just due to the overall patterns that I'm seeing playing out with any given setup. So sometimes you need to be quick locking in profits and taking singles to avoid giving back too much in unrealized gains if the market is having trouble sustaining moves. Other times it pays to be patient and catch the occasional home run trade when the conditions warrant that approach. It's up to you to be in tune with the market and what it's offering in order to vary your style to best take advantage of the current opportunities. So pay close attention to what the market's offering and how that should affect your trading. Always be flexible and adapt to the changing environment. Sometimes it pays to play offense, and sometimes you lose less playing defense. If you like this video, please smash that like button, subscribe for more content like this, and I will catch you guys next time.